with me now is regular guest of Taipan Financial News and editor of Diligent Investor, Todd Schoenberger. Todd has a different take altogether. Welcome, Todd.
Thanks for having me again, Sandy.
Now, Todd, you expected a pause, right?
That's correct.
Why did you think that?
Well, the Fed is finished with this current rate cycle, Sandy. We went through 17 straight rate increases, and the Fed paused at the last meeting on August 8th, and they paused again yesterday. It was fully expected because the economic data isn't justifying any further rate increases for now.
But Todd, isn't it possible that they could certainly turn around and start to maybe increase rates?
Well, anything is possible, but when you look at the clear economic data, for instance, the government released 19 separate economic reports between the August 8th meeting and yesterday's meeting, and 50% of them actually came in lower than what guidance had offered for inflation concerns. So right now, the trend is that inflation is benign. We haven't seen any clear-cut signs of inflation, and as a result, the Fed really has no evidence or any real justification to increase rates from here on out.
So you're betting they're done?
I'm absolutely betting they're done. I think that they are completely finished. For example, the core PPI number, the producer price index number that came out on Tuesday, that was only the fourth time in history that we had back-to-back negative core PPI numbers. I mean, think about that. Inflation is clearly stable. The economy is growing. We just had a revised second quarter GDP rate come in at 2.9%, and the previous print was at 2.5%. So right now, the economy is growing. It's moderating. It's doing what it needs to do, and inflation is in check. And as a result, the Fed does not have to worry about or concern itself with raising rates again.
But Todd, in the statement, in the committee statement, it said the committee judges that some inflation risk remains. So you're suggesting, though, that inflation is done. I'm not sure I understand here. If the committee is saying that there's some risk, you say it's done. Isn't it possible they could raise the rates?
Well, the economists that work at the Fed, as well as the members of the FOMC, are clearly going to put that type of language in their statement. They need to. They need to keep that door open just in the event that there are inflation concerns, or maybe the economy would even grow again. I mean, for example, if we have a third quarter GDP rate that pops up over 3%, maybe 3.5%, if that happens and maybe oil prices go back up, yeah, that could be justification. But right now, there's no firm evidence right there for the Fed to have to increase rates from here on out.
Well, what would have to happen for them to increase rates? What kind of things would have to occur in the economy?
Well, the diligent investor went back to prior 35 years, and not one time did we ever notice that the Fed or the FOMC ever increased rates when gross domestic product in this country was below 3%. And like I said before, we had a revised print of the second quarter GDP at 2.9%. So to answer your question, we're going to have to see some moderate growth, but moderate and steady growth in this country that's going to go over the 3% threshold. But on top of that, we're also going to have to probably see oil prices go back up. And if they do go up, we'll probably start seeing prices go up. And that means inflation. And then that would mean further rate increases.
Okay, let's talk about oil for just a minute. So what would cause a spike in oil prices?
Well, clearly supply and demand will cause it. Right now we have oil has been dropping considerably. Actually, we're at 61 and change now per barrel after reaching a high of 78 and change in mid-July. But really, there are no bullish factors out there for energy traders to start bidding up prices for crude. And we had a very benign hurricane season. We're past Labor Day, the peak driving season in this country, if you will. So as a result, oil prices are just, they're steady now, and we're waiting for some big bullish news to really happen, to really spike oil prices. What can happen? Well, clearly a very raw and cold winter would boost energy prices, as well as maybe some geopolitical concerns.
So Todd, what are you recommending investors do with their money now?
Well, when you take a look at history, and history really is the gauge that I look at, looking into the future and trying to forecast where investors should go. And when you look at the fact that if we're between rate cycles, if we're in that time frame, the S&P 500 will always dominate small cap issues. So what you want to look for are high quality, dividend paying, growing companies, real value oriented companies, some of your brand names that are out there. That's what the investors should look at.
That's what I was just going to ask. Could you define what you consider a quality dividend paying stock?
Well, a quality dividend paying stock will be a company that has a competent management team, a company that knows it has a fiduciary responsibility to their shareholders. They have a history of buying back stock. They have a history of increasing the dividend, maybe even offering a special dividend. One example I always like to talk about is ExxonMobil. ExxonMobil has paid out over $40 billion in dividends to their shareholders over the past 6 years. They know that they have a fiduciary responsibility to their shareholders. They have a competent management team. They're making a lot of money, billions of dollars each year. Just last year, their net gain was $36 billion. And as a result, those are the types of companies you want to look for.
And those are what you're recommending in Diligent Investor?
Yes, I am.
Okay, thank you, Todd.
Thank you, Sandy.